triple header of central bank meetings will set the macroeconomic tone in the week ahead as the US Federal Reserve, Bank of England, and European Central Bank all make their first policy announcements of 2023 on the 1st, the 2nd, and the 2nd of February, respectively. In order, the Fed took the Fed funds rate to 4.5% from just 1/4% in 2022 and also began applying quantitative tightening, or QT, whereby it began to run down the assets on its balance sheet at the rate of $95 billion a month. Thus far, the central bank has shrunk its assets by 5% from the peak to $8.4 trillion, but that's still more than double where it was before the pandemic and nearly 10 times 2007's levels before the Great Financial Crisis. The CME FedWatch service shows that markets think the Fed will slow down its pace of rate increases with a 1/4 point hike this time around to 4.75%, with another quarter point in March, maybe one more in spring, to a peak of 5.5%, and that is seen as the peak, with the first rate cut seen coming in the fourth quarter. The Bank of England raised its base rate more slowly than the Fed last year and was also more cautious on QT, although it had done a lot less QE as well for good measure. Governor Andrew Bailey and the Monetary Policy Committee hiked the headline cost of borrowing to 3.5% from 1/4 over the course of the year, and also embarked upon QT at the rate of £80 billion a year. Remember, total assets peaked at £895 billion. The bank has managed to sell the government bonds or gilts it acquired during the autumn panic caused by Trussonomics without any drama. And at the Monetary Policy Committee meeting on the 2nd of February, Mr. Bailey and his colleagues are expected to raise the base rate by a 0.5 percentage point to 4%, before another couple more rate hikes in the spring to a peak of 4.5%. As with the Fed, markets are expecting then the first quarter point rate cut in the fourth quarter. Note, however, that the 2-year UK government bond, or gilt, well, its yield stands at just 3.46%, and that's got a history of leading the Bank of England base rate by 6 to 9 months. The past is no guarantee for the future, but that suggests the bond markets don't believe the Bank of England's tough talk and thinks rates may peak lower and then be cut sooner than some think. Then we get to the European Central Bank, the last of this trio to raise rates and the last to embrace QT. The ECB increased its main refinancing rate to 2.5% from 0 last year and stated that QT will begin in March 2023 as the central bank ceases to reinvest cash and bond holdings that mature. This follows a balance sheet reduction in the autumn caused by banks' repayment of some €800 billion of the cheap TLTRO financing schemes that date back to 2014. The initial run rate for ECB QT is €15 billion a month, and that will then be reassessed in June, though that's a tiny sum compared to the ECB's €8 trillion balance sheet. As for this policy meeting, consensus is looking for a 0.5 point rise from the ECB, but there has been some debate of late that only a 1/4 point could be on the cards. Now, all three central banks are trying to rein in inflation, avoid a recession, and not upset stock and currency and bond markets at the same time. No easy thing. And while it's interesting to hear the Davos crowd and the International Monetary Fund talk more optimistically about economic growth, stronger growth could mean higher interest rates stay higher for longer. And in that hypothetical scenario, that could be good news for the economy, maybe bad news for financial markets, which are looking forward to more cheap money. We shall see. On the corporate front, quarterly results season in America reaches full throttle in the coming week, with a busy slate here in the UK as well of trading updates, interim and full-year results. Companies which may be worthy of further research include the following, although do bear in mind that some of these dates could still be subject to change. Computer Centre on Monday the 30th of January, Pets at Home, ITM Power and Ceres Power on Tuesday the 31st, GSK, Vodafone and Glencore in a heavyweight day on Wednesday the 1st of February, and then BT, Sage, Airtel Africa, NCC, Renishaw and Cranswick on Thursday the 2nd, when JD Sports will also hold an analysts meeting. But the company that could just cause the biggest fuss in the week ahead is Shell. The oil and gas major is due to publish fourth quarter results on Thursday the 2nd of February, the first set of figures to be released under new chief executive Vail Sawan, who took over from Ben van Beurden at the end of the year. The shares are up by 1/3 over the past 12 months, even though Brent crude is down by 1/4 from its 2022 highs, and natural gas has more than halved. Both commodities have started 2023 strongly, however, thanks in part to the argument that China's post-lockdown reopening could boost demand, while sentiment towards the Shell stock has been boosted by increased dividends and a share buyback program, of which more in a second. So analysts will, when it actually comes to the numbers, look at a number of key headline figures, and the first is profit. Shell's preferred metric is not a statutory one, but is in fact adjusted earnings before interest, tax, depreciation and amortization, or adjusted EBITDA. For the full year, analysts are looking for $83.7 billion against $55 billion a year ago. And for the fourth quarter alone, that implies adjusted EBITDA of $20 billion against $16.3 billion a year ago. Analysts will also look to the mix of earnings between the different business operations: upstream, integrated gas, marketing, chemicals, and renewables. Attention will then switch to cash flow from operations, which hit the double-digit billions figure for the fifth time in 7 quarters in Q3. And cash flow is important because it funds investment in the business, and after that, dividends and buybacks for investors. Shell returned $6.8 billion to shareholders in the third quarter alone via a buyback and 25-cent a share dividend payment. Shell also launched a new $4 billion buyback for the fourth quarter alone to take 2022 total to $18 billion, and flagged a 15% increase in the fourth quarter dividend to 28.75 US cents a share. Watch here for any guidance for 2023 from the new CEO. The last number that may grab headlines is capital investment. Analysts looking for 2022 to come in at $23 billion, up from $19 billion, with a prospect of a small increase in this coming year. That leaves the capex to sales ratio in the middle of its historic range, and no more, even if oil and gas prices are still relatively firm, demand seems okay, and supply isn't growing much, if at all. Moreover, the mix of spending will be important as Shell seeks to reposition itself for a net zero carbon world. I hope that you and your families are all well and in good spirits. Thank you for watching, and I look forward to seeing you next time.